So I think in the interest of time, I think we'll go ahead and get started. Thanks. Good evening, everyone, again, and thanks for taking the time to join Giraffe Connect on the evening time. We thanks for taking your time and participating in it. And today we will talk about one of the product categories that we normally bring regularly on our platform, which is the invoice discounting. In terms of agenda, I'll do a quick introduction and I'll have with me the co-founder Saurav as well, and he will introduce himself. And given the fact that there are a lot of folks who might be new to Giraffe and coming and hearing about us first time, I'm going to take a very short amount of time, like 5 minutes, to just give a little bit of a quick background on what Giraffe, the team, and where we are. And I'll spend majority of the time along with Saurav to talk about the invoice discounting product, and then try to answer as many questions as possible in terms of someone has said there is an echo. I'm going to assume, Saurav, you can hear clearly?
Yeah, GP, I can hear you clearly, but there is a bit of echo. Not sure if it's a mic.
Okay.
But anyway, I think we can continue.
Continue on this.
Yeah.
Okay. So with that said, so myself, I'm Jay Prakash, JP, and I've been a Giraffe for about 9 months. Before that, I was managing a business head for Home Credit. So I've got 18 years of experience, primarily in the financial services space across different financial institutions. And with me, I have Saurav as well. I think, Saurav, you can introduce yourself.
Yeah, good evening, everyone. Thank you for taking out time on a Thursday evening for this webinar. My background, I'm a computer science engineer from Bitspilani, Goa. Did my MBA from Ahmedabad, passed out in 2012. Post that, I was basically in the corporate finance space. I used to be raising debt capital for the company that I worked for. Worked in the infrastructure and the real estate sector, and both being very capital intensive. I've basically done a fair amount of, I would say, transactions in debt and structured credit, raising capital from international funds, domestic funds, private sector banks, public sector banks. So on the debt side and on the structured credit side, I would have done probably the entire gamut of transactions, that's out there in the market. So, and then obviously started off with Giraffe. So that's my short journey.
Yep, I think thanks, Saurav. In terms of where as I said, I'm just giving a quick introduction. So Giraffe, this is a quick look at the Giraffe team. So most of us have come from quite a lot of experience and worked in both domestic players, international players, large firms in various capacities. I'm not going to go through each one of them, but definitely, when you talk about Vineet, who's the other co-founder of Giraffe, who's got tremendous amount of experience in the raising debt. Previously was with Piramal and has got good exposure into a lot of sectors in terms of raising capital and on the debt side of things, just like Saurav. And as you can definitely go through a LinkedIn profile, but I think the point that I want to bring it here is a majority of them have worked in large institutions and then have come together to build Giraffe and to create value for our clients. I think that's the background of the story that we have. With that said, we're also backed by top investors from Axel to Capital A, and a lot of folks who have supported us right from the starting of the journey when we try to raise capital in terms of seed. So that's the thing. This one, I want a little bit touch on this. So this is not a full gamut of everything, but I would probably at least call out is we try to have a platform that has a good amount of option in terms of product categories in the fixed income space, whether it is an unlisted corporate debt or commercial papers, which are debt, invoice discounting, which we'll talk about a little bit, asset leasing, venture debt. Each of them have got a different type of structures in terms of tenures, the security, how collateral, what kind of tenors and they have, what kind of returns they'll provide. So we try to create that product categories, and within each product category, we try to bring different counterparties. So I think at the end of the day, it provides an option for the clients to not only diversify across the product categories, but also provides an option for them to choose the counterparties within each product category, that thereby creating a good platform that covers a good mix and it kind of we want to make sure that the clients have a good opportunity to diversify across all different type of products and counterparties. So that's a quick one, but obviously I want to spend more time on the inverse discounting. Uh, okay, perfect. With that said, I'll just quickly go through. Okay, I think here's the journey so far. So we started in September 2021. So we are about 16 months counting. And so as of March 23, we've got about 1,300 plus crores of investments that we have raised from clients. And we've got the 75,000 registered users. Our team has grown as well, and we've repaid 700 crores back to the investors with zero defaults till date. And that's primarily because of the amount of credit assessment that we take internally, which we'll talk about it when we talk about the product. But that's a quick journey so far in terms of where we are. With that said, I will probably now shift my discussion more towards the product that we want to talk about, which is invoice discounting. And as you are probably, for people who have already come to our platform and seen, you would have seen a lot of opportunities on invoice discounting. With that said, I think Saurav, a lot of times people do ask the question about how does it work, invoice discounting, and how do we come in and in a basic term what it means and how it works. Maybe you can start off with that explanation, and then we'll go from there.
Yeah. So JP, there's just some animation on this slide, so as we keep talking, probably we'll have to.
Sure, absolutely. Yeah, absolutely.
So yeah, so again, thank you everyone for joining in. Just to explain in a very simple term what invoice discounting actually is. So on the right side, if you see there is a seller or a vendor and a buyer, what is the role of these two counterparties in a trade? So typically the seller or vendor is the company that is providing goods or services to the buyer or anchor. And these are terms that typically get used very actively in the invoice discounting space. So it's important to understand. So typically a vendor will be the one providing goods and services to the buyer or the anchor. So what that means is that the goods and services is being delivered by the seller or the vendor, and the payment is being done by the buyer or the anchor. So after the defined credit period, or that is whether that is 60 days or 90 days, the buyer or the anchor is going to make the payment under the invoice. So the seller or the vendor is raising an invoice to the anchor. That's the way to think about it. Yeah, JP, will click next. Yeah. So what typically happens in an invoice, when an invoice gets raised, is that because the vendor has already delivered the goods or the service, they have already incurred that cost. And so if I'm basically delivering, let's say, any product, whether it's a dairy product, like let's just say that a vendor is providing some dairy product, the manufacturing cost of that product has already been incurred by the vendor on day zero, and they have supplied that product to this anchor, and post the anchor actually accepting the product, the vendor is raising this invoice. Now what happens is the vendor has now already incurred the cost for providing the goods and services, but the anchor is going to make the payment to the vendor after a defined credit period, which is whatever is mutually agreed under their trade documents. That typically we see 60-90 days. So because the money is being paid by the buyer after 60-90 days, the vendor has a working capital deficit, or what we call a cash flow deficit, because I have incurred the cost today and I'm waiting for the payment which will come after 90 days. So as a vendor, if I want to grow my business, then I need to have a lot of capital at my end, because I know that every time I incur the cost, I get money 90 days later. So this lag will continue to grow as I keep scaling. So if I'm doing 100 crore turnover, then I need that much more capital, because that much money will be stuck in this working capital gap, where I'm waiting for payments to come in from an anchor. So this working capital gap basically defines the need of invoice discounting as a product. So what essentially happens is that any financer typically discounts the receivables from the anchor. So as soon as an invoice gets raised, two things happen. There is a once the invoice gets raised and the anchor has accepted the invoice, there is a payment obligation from the anchor to the vendor. Now, because there is this payment obligation, there are financial institutions who are ready to take a call on this payment obligation, discounting the receivables that the anchor is supposed to pay and giving the money upfront to the vendor. Now, what the use case over here is that the vendor is getting the money upfront by discounting the receivables that they are likely to get from the anchor after 60 or 90 days. So the vendor, the cost is getting incurred on day zero, and by discounting the invoice, they are also getting the payment for the goods and services on day zero. Now, for getting that payment on day zero, they have to pay a cost of capital, which is what the interest is or return is, right? So instead of getting money 90 days later, you're getting money on day zero. Money has a time value attached to it. Because you're getting money now 90 days prior to the defined period, there is some cost of finance or cost of that cash flow coming early to you, which is attached to this trade. And this entire trade, which is basically financing this receivable, is basically what invoice discounting is, right?
Perfect. I think thanks, Saurav. So with that said, I think one of the things is the variance, right? Because we have both variants on our platform. We do have receiver-based financing, and then there is the vendor payables by financing, payables financing as well. So maybe we can also differentiate that. So when people look at the deals, they can understand it better.
Yeah. So their underlying nature is the same. Basically, there's a vendor who is raising an invoice to an anchor, and the money goes to the vendor under which is by discounting the invoice. Now, the reason there are two names to it, essentially differentiation is that who is approaching the financer. So when the vendor comes to, let's say, a Giraffe and says that, hey, I have raised invoices to these large companies, can you give me upfront money by discounting these invoices? Then we will call this a sales invoice financing. Now there is another case. Let's say there is a large anchor and they come to us and they say that, hey, we have invoices that our vendors have raised to us. They need support. Why don't you give them capital upfront with my comfort that I will pay you after 60, 90 days? Here, because the initiation has been done by the anchor, towards, I would say, goods or services that the anchor has purchased. That's why this is called purchase invoice financing. Basically, the anchor coming to the financer to finance their purchases, where the money still goes to the vendor only. But because the anchor has approached us, this has become a purchase invoice financing. So it's largely the underlying trade remains the same. It's from which angle or which side of that trade that you are actually evaluating it. It is called sales invoice or a purchase invoice financing.
Okay, thanks, Saurav. So, and we do have, by the way, for folks, we kind of try to make sure during our deal you will see words of anchors and vendors which will cover in. And that will tell you a difference on our platform when you kind of try to invest on any of these parties. I think one of the ways we think we can go is to understand, explain this process for the receivable discounting. And I think Saurav, maybe we'll start with this, and then I'll try to move around little by little while you walk them through the flow of how invoice discounting money moves and how the investor comes into the picture. So with that said, these are the players.
Yes.
Correct.
So as you can see on this slide, there are 4 parties involved in a invoice discounting transaction when you do it through Giraffe, right? So there is a vendor, there is an anchor, there is Giraffe, and then there are customers, which are you individual investors. In this case, this is a recent opportunity we had listed where Zetwork was a vendor, Arvind Fashion was the anchor. So what that means is that the Zetwork had provided some goods or services to Arvind, and Arvind Fashion was due to pay Zetwork after 60, 90 days. So we were discounting receivables of Arvind Fashion and paying that money upfront to the vendor, which is Zetwork in this case. Right. So let's look at the investment flow of the journey on Giraffe.
I think this is
step
clear.
1.
Yep.
Yeah. So step 1 is basically the invoice getting raised. So Zetwork, we now have a bunch of invoices which Zetwork has raised to Arvind Fashion, and Arvind Fashion has accepted these invoices. So this is step 1. So these invoices now exist. Step 2 is now Zetwork comes to Giraffe and tells us, hey, we have a bunch of invoices which we have raised to Arvind Fashion. We are expecting the payment in 60 days. why don't you discount this invoices and give us upfront cash? So if this passes our credit approval process in Giraffe internally, we list these invoices onto the platform. Once we list these invoices onto the platform, individual investors are able to express their interest, and then people who want to participate, they can transfer funds which flow through a SEBI controlled escrow account, which basically then goes to Zwork, right? So the investment process is that the money goes to Zwork, which is the vendor in this trade, against the receivables that it is due from Arvind Fashion, right? So this completes the investment flow. In the repayment cycle, what happens is that post 60 days or 90 days, the anchor, who is Arvind Fashion in this case, will be making the payment to Zwork. Zwork in turn will be making the payment to a escrow account, that is again controlled by Giraffe, and then the money gets distributed to the individual investors, right? So this is the repayment part of the process. And I think, otherwise this is quite self-explanatory. We can take questions on this, if there's any.
Yeah, I think normally I think I see a lot of questions. This came even before we went into this slide, right? So I will at least, I think for all the listeners, right, I will try to make sure that all questions are answered, but I'll try to pick questions, try to vendors should approach financial for payment, why anchor should approach. So this is Mithilesh. So in this case, it is the thing which was stalked by Saurav. It is the vendor who approached the Giraffe. So I think your answer is clearly there, right? So the vendor approaches, it's not the anchor who approaches the Giraffe. Here the vendor approached Giraffe to discount because they are given the goods to Arvind and they're waiting for the money from Arvind. But Zwork wants money now, so they are approaching Giraffe too. So I think we have answered the question, Mithilesh. Hopefully,
I just see a few more questions on whether Giraffe does sales invoice financing or purchase invoice financing. Like I mentioned, for a customer or even for us as Giraffe, the technical term is not relevant. What we need to see is who the anchor is, who the vendor is, and what the underlying trade is. So, for example, in this case, if Zwork had approached us, it automatically becomes sales invoice financing. If Arvind had approached us, it would have become purchase invoice financing, but the underlying trade would not have changed, right? Our relationship with the counterparty is important to us in analyzing the credit, which we will talk about it, but we do both ends of the transaction. When you see any invoice listed on the platform, if you click on that opportunity card, it will clearly talk about who the anchor is and who the vendor is and who the obligor is. Typically, the obligor is basically will define, whether it is a sales invoice or a purchase invoice financing, because typically we make the obligor the counterparty with whom we have a relationship. So because if we have a relationship with Zwork, it will become a sales invoice financing because that means they would have approached us. And if it becomes an obligor, becomes Arvind Fashion, then typically because they would have come to us, we would have passed on the credit risk to them. That means it would have become a purchase invoice financing. So please click on the opportunity detail, note who the vendor is, who the anchor is, and who the obligor is. All these three things are important data points for you to note.
Yeah. Okay. I think a lot of questions on risk. I will wait on those questions because we'll go to there and then we'll answer that. I think for Chirag, I think hopefully there is clear what type of invoice discounting Giraffe does, purchase or sales. I think as Saurav said, we do both. So in the cart, you will see both vendor and anchor. So you'll understand how that works, but we have done both. Okay, okay, so I think I'll go to the risk and then I'll again come back on this one. So I think a lot of questions would come to, okay, what are the risks, right? Because obviously we're talking about investment. So I think some of these are fixed income. Maybe you touch on this and try to expand how invoice discounting adds even more, maybe a little bit different from this.
Yeah. So for everyone, we are a fixed income platform. So all products that you see on Giraffe are fixed income in nature. These are three standard risks that any fixed income product sees, which are not invoice related. We'll go into the nuance. These risks exist even in invoice discounting, but in invoice discounting and every other product, there are more risks other than these standard risks. So the first thing in any debt product is, what is the capability of the company to repay? And that capability of the company to repay comes from what we call as credit risk. So when we are looking at credit risk, we are ascertaining the capability of the company to repay. if the company is unable to repay on the specific due date, that will lead to a default. This risk of default is called credit risk. Second is liquidity risk. These typically today in in equity markets, when you own a share, you can sell your share immediately, through your demat account or your trading account. That means there is very high liquidity. If you place a sell order, you automatically get matched to your buyer, and there's high liquidity. In these kind of products, if you want to exit your investment before the maturity date, you will not be able to exit it, because typically you don't find another buyer, because these are not very liquid products. So this is what we call liquidity risk, that when you invest in these products, you are expected to hold your investment to maturity. You will find very few takers in case you want to exit the investment prior to the maturity date. This risk is called liquidity risk. The third is though I spoke about capability to pay, we also check intent to pay, right? And this is where fraud and intent basically comes in. And there are multiple cases in India that everyone knows about. So this becomes then a key risk in any debt financing product.
Okay, and then if you want to move to the invoice, I think sometimes it's split screen. So I think this gives a clear picture of what the invoice discounting aspect, what the risks would be. So I think Saurav, we want to.
So these are now specific risks related to an invoice, and these are risks which are, I would say, which we try to solve for. So I will talk you through the risk as well as how we intend to mitigate. How Giraffe does the entire credit assessment process and how do we do a risk evaluation is something we have spoken ahead in the slide as well, right? So first is today fake invoices, invalid trade, disputes. What this typically means is the invoice that has been raised actually is a fake invoice. There was no good or services actually delivered. The trade does not exist because either the trade never took place or the trade got cancelled and there was an invoice however shown to you. Third is that the good and services has been delivered, invoice has been raised, but the anchor or the buyer is actually disputing it, saying that either it was not to the quality or to what was agreed as per commercial terms, right? So there might be some commercial term that they have agreed, which was and the trade was not completed as per those agreed commercial terms, because of which the anchor can raise a dispute. Now, in all these cases, what happens is that the anchor is not going to. You're expecting that a payment will come from the anchor, but it will not come because either the invoice is fake, it is invalid, or the anchor is disputing it. So in these cases, how do we mitigate? Every invoice that we actually discount, it gets mitigated, and it gets mitigated in three ways. First is to check the veracity of the invoice. Typically, when there is a delivery of goods or any service of goods, you get a lorry receipt in case of delivery of goods. You will also get an acknowledgement from the anchor whether they have accepted a good receipt note, which is called a GRN number. So typically, these are unique identifiers for a particular trade, which we keep tracking to know whether the actual good or services has been delivered. The third is obviously the anchor needs to accept the invoice itself. So either we get an anchor acceptance, or typically large anchors have vendor management portals where you can go and check whether these invoices have been accepted or not. So as Giraffe, we are very particular that we are only discounting anchor accepted invoices. So there is that risk of fake invoices, invalid trade, or disputes kind of get mitigated. Second is same invoice being discounted by multiple parties, right? So this is essentially you go take the same invoice, you go to multiple lenders. This is a risk that exists, again, which is again prevalent in the market, right? Here it gets mitigated in two ways. We obviously, we only work with very reputed anchors or vendors. So both anchor and vendor typically will have, large turnovers where we work with. Especially whoever we pass on the obligation to, they will be reputed names. Second is that typically whenever there is these multiple invoices getting raised, you need to be clear that who the other working capital lender is, right? So we are very particular to see that if there is any other bank or any other working capital lender to this company, because then these kind of risks can exist. So we doubly check. We also take a lot of reference checks from their existing bankers, so that they are also aware that Giraffe is doing a trade, and we are also, and are very cognizant that there are two working capital lenders to the same company. Third is obviously there is a lot of legal protection that you do. So you take covenants, representation that all these invoices that are being discounted are unencumbered, and they don't, and that they have not gone to discount the same invoice somewhere else. These are representations that you take. In case you find this to be false, you can actually call a default, take this company to bankruptcy court, and have all process that is there under law, under this invoice, right? So these are some steps we take to basically ensure that this risk gets mitigated. Accommodation risk, a lot of times you will see, and is again in India, there are companies which are like, I as the anchor and maybe JP as a vendor, both of us can agree that we will keep raising fake invoices between the two of us. Anchor will give an confirmation for acceptance. So we both have agreed that there is a financing route. You can raise an invoice to me, I will get it discounted from a bank. So we get money without actually doing trade. So the vendor accommodating the anchor or vice versa, this is called accommodation risk. How do we mitigate this? Again, work with very high reputed name. Both anchor and vendor should have a long operational track record. The vendor should be a meaningful service provider to the anchor. And third and foremost is, we don't do any related party transaction. If we feel that there is any overlap between the anchor or vendor in any sort, we will not do these transactions. And in fact, we have rejected 2 to 3 credits just because of this accommodation risk. Collection risk of the invoice. So collection risk of the invoice is essentially credit risk. I spoke about it. So typically there are two things in collection risk. One is that the money not coming in, but also the money coming in late. And typically in trade, what happens is that because of several logistic issues, the money gets delayed. Right? Because typically large companies have their accounting system. They need to verify the invoice. Their accounts need to, approve it. They will also have typically one payment day when they actually clear invoices. Again, some data mismatch, some GST not reflecting, something not reflecting in the government databases, GST not paid on an invoice. Like because of something, minor dispute, account number is incorrect. Lot of small issues actually lead to risk of delay, which is the money was due in 30 days, but it is actually coming to 30, 35 days, 40 days. How do we mitigate this risk? We mitigate this risk through a lot of data. So what we do is we look at the operation track record of a vendor with an anchor, maybe for the last 12 months, last 24 months, last 36 months. We look at the turnaround time of every invoice. So the invoice was raised on X date, there was so much credit period, when did the money actually come in? And over a period of 1, 2, 3 years, you will figure out that this is the typical TAT. On good case basis, it typically comes in on the due date. On a bad case basis, there might be a delay of up to 7 days or 15 days. How do we build this? We build this by providing adequate buffers, right? So if we feel that there is a track record of delay of 7, 10 days or something, we will build in that delay in the due date of discounting. So if the due date is 50 days later, we will do a discounting for 60 days. If the due date is 80 days later, we'll do a discounting of 90 days. So that kind of ensures that these kind of delays due to small operational challenges are not there. Finally, intent to pay, like I said, is a part of the credit process. So you work with reputed name, and that is a part of the credit check that you do, where you're evaluating the intent or capability to pay. Last, risk is a very important one, because you will have seen a lot of, I would say, platforms tell you that, hey, there is a invoice by a Pepsi, invoice by a Coke, invoice by a Siemens, ABB, and they are giving you 18, 19% return. One thing to be very cognizant of these is commingling risk, and what is commingling risk? We are assuming in invoice that the money is coming from, let's say, a large name like a Pepsi. And we are saying that, because Pepsi is going to make the payment in 60, 90 days, how can there be a chance of delay or default? Because Pepsi is a large conglomerate, they will definitely not delay on this payment. But the existential risk here is what is commingling risk. What typically happens is, with very large vendors, they pay to a vendor designated bank account, which is already logged in into their vendor portal. And because these are large conglomerates, it is not easy to get the bank account number in their vendor portal change. So what happens is, you have discounted an invoice of Pepsi, but Pepsi on the due date will pay to the bank account of the vendor. Now you as a financer is dependent on this vendor to repay that money to you on the due date. This money, this risk is called commingling risk, because what happens once the money hits the vendor's bank account, then the risk has moved from Pepsi to this vendor, and it is about this vendor to then repay you. Now, most of the times where you have seen that a large corporate is giving you 15, 16, 18% return, typically what happens is it's a very small vendor who has raised this invoice, got it discounted. There is a big commingling risk that takes place at this vendor, and that is why you see this very high return on this particular invoice. How does Giraffe mitigate this risk? First, whether we are very clear whether this commingling risk exists or not. If this commingling risk exists, then we will fairly price the opportunity according to that commingling risk, right? So in case there is a risk, we will price it according to the vendor's risk. Third is that we don't work with any small vendor. Any ABC vendor who comes to Giraffe with a Pepsi invoice or a HUL invoice, we will not give them money. All the vendors that we work with, where we are doing receivable financing, most all of these guys would have turnover of more than 100 crore plus. They will be players with very high balance sheet strength, very high financial strength. They will also have other working capital providers to them. We do a lot of reference check with these guys. We ensure that the credit of this particular company is very good, and then only we work with them. So we are not dependent only on the fact that the invoice is raised to HUL. We are doing a thorough credit check of the vendor. We are ensuring that the credit history of this vendor is very good. It is a very clean. They have dealt in their past with integrity. They are operating that business at a large scale, and only then, and they are financially strong, and then only we work with them. So the existence of commingling rings, acknowledging it, and then suitably structuring it is what is critical, and that is what we do.
So I think this is a good point you're raising, Saurav. I wanted to at least have this again the conversation. It is not about a mom and pop shop having an invoice of a large firm. It means that it's fine. We are discounting a large firm's invoice. It is the aspect of the company, the mom and pop shop, whatever company, the vendor we are talking about, is the credibility of the vendor, the size of the vendor, the ability for the vendor to pay, which is also a big component when we talk about the invoice discounting, not necessarily what kind of invoices the vendor is actually discounting, right? I think that's something I definitely would call on from investor standpoint when they evaluate an opportunity, have a view into understanding the vendor, not the actual invoice that is getting discounted, but the vendor's capacity, what kind of vendor it is, their credibility and everything. I think that's a good point. I just wanted to call that out because I think I do get a lot of questions on a regular basis on customer service. So with that said, I think one of the big questions would be is, okay, I understand the risk, right? But then the question goes is, I think you covered some of it, is the framework that we use when we are evaluating the opportunity. And Atul and Saurav, I think it's very important for us to also call out like the number of deals that we normally evaluate and how many deals we actually approve. I think that will give a good sense of for the team, the framework, how strict we are in the framework and how comfortable we want to be before we bring any opportunity. I mean, at the end of the day, I'm not saying there's no risk to the investments. Investments carry risk, but I think we trying to make sure that we have a sound credit assessment framework before we bring any opportunity.
So this is a credit assessment framework only for Invoice as a product. So for every product that we do, we have our proprietary risk models. We have our own framework. Over a period of, in the next 3 months, you will also start seeing us publish these risk scores for you to, absorb them. We have been doing a lot of back testing, internal testing to ensure that, this is consistent data over a period of time, which we will start publishing, going forward. I saw this question in the chat and, hence touching upon this point. Today too, we have worked as Giraffe with about 42 companies. We typically like to take large exposures with them so that we ensure that we don't work with very small companies or very small name. These companies should at least have large operating track record. They should have a decent brand in their space, in their sector, even if it's not a consumer brand. These are check boxes that we have when we work with companies. We have met today and evaluated more than 450 companies to work with 42 of them. So our conversion from actually meeting to doing a transaction with the company is less than 10%. That's the kind of diligence that it goes through. We spend almost 2 to 3 months with every company for transacting with them for the first time. Post that, we also do a monthly credit review process, which I will talk about. But coming to this slide, which is our credit assessment framework for invoice discounting as a product. So there are 5 things that we see. Actually, the last number is wrong. So it's on the right, it's 1, 2, 3, and then 4 and 5. The first is counterparty risk. So you need to be clear who the anchor is, who the vendor is, on who in this entire trade, on whom is the risk lying. Are you dependent on the vendor to repay? Are you dependent on the anchor to repay? And are you doing a credit check on the right counterparty? Like I said, if there is a commingling risk, there is no point checking whether the invoices of Pepsi or HUL. Obviously, it gives a lot of comfort because their collection comes through. But finally, the risk is on the vendor. So is the vendor credit worthy? If you had to give a loan only to the vendor without the invoice, would you give a debt to that vendor? Right. So counterparty risk and being aware of it is very important. In this, obviously, the quality, the criticality, the relationship history, can the anchor tomorrow throw out the vendor? What also happens is, in a lot of cases, let's say the vendor gets substituted. So the anchor will say that, hey, I am going to remove you. I have another counterparty who will give me better services. So I'll stop transacting with you going forward. So the last invoice or the last few invoices, post that communication typically will get delayed. So it's important that the vendor is important to the anchor. They face low threat of substitution. There is a lot of history between them that becomes then critical. Second is structure. We spoke about commingling risk. You have to be again clear, on who is the recourse and what is the recourse, right? And then how do you protect yourself from default events through a legal structure, in either case. Second is commingling risk. Third is other securities that you take basis what the data from 1 and 2 is, right? So we can take guarantees, we can take performance guarantees, we can take collection guarantees, we take indemnities, collateral, PDCs, right? Which are post-dated checks. So all of these are possible. Once we know what risk 1 and risk 2 is and how it looks like, then we structure the trade accordingly. Third is capital requirement. One of the things that we are very clear is that we only want to finance genuine working capital need. It's not like the company does not need money, but finds anyone as an easy source of capital by invoice discounting. We do that, but actually they are not using it for their working capital need. It is they are doing it for something else, right? So we only want to finance genuine need. How do we determine that? We look at their working capital cycle. Genuinely, do they have a working capital cycle? Is it 60 days? It is 90 days. In typically, what is the turnaround of their inventory? These kind of things tell us that what is their actual working capital need basis their turnover, and are they adequately financed by a bank? If yes, we don't want to do a transaction because they are adequately financed. If no, yes, then they have a genuine need and we are happy to help, right? So that becomes critical. We also look at concentration risk, right? Because what sometimes it happens that a vendor has a lot of payments, like 80% of their revenues come from one counterparty, right? So what happens is that in that case, if that counterparty goes away, the vendor's financial strength will severely deteriorate, which becomes a red flag for us because that's not something we can control. So those are the kind of things when we look at what their capital requirement is and what risk is there. Then comes financials. These are very typical, which we do across all things: balance sheet analysis on their leverage, liquidity, financial parameters of profitability, turnover ratios, return on equity, operating parameters on business model, margins, etc. Finally, validation of the trade. We spoke about all these risks: validating invoices, validating the movement of goods, validating customer acceptance. Then how do we build in the risk of delay in payments, etc. Right? What is the trade document between the anchor and the vendor becomes very critical. What are the terms? What is the term of termination? What is the term of payment? What happens in case of a payment or in case of a delay? Those are all things. So underlying trade documents becomes very important then to evaluate. So across these 5 parameters, we understand what the risk of the underlying trade is. This is actually summarized, and for you guys to understand, it is actually a lot of work of around 2 months. which we've tried to summarize, to give you a thought process of Giraffe when we look at invoice discounting as a product.
Hey, thanks, Saurav. There are a lot of questions I've been trying to answer while doing it. I think one of the other things normally I do get would be is uh, maybe we can also talk about Saurav, right? I think our ratio of the opportunities that we evaluate to the opportunities that we bring to the platform is almost like 10, only
Less than
10%.
10%. I
Yeah,
just
less
spoke
than
about it.
10%. Yeah,
So
perfect, right? I think
yeah.
that's important as well, because a lot of the, and then even for the investment side, there's always the question of, okay, we have come as investors and we have done the investment. So is Giraffe's role ends there? But I think that's not true the case. I think we try to make sure the post monitoring of every counterparty is being done until the money is back with the investor. Maybe you can walk through this in the how we manage every counterparty.
So this is a lot of text. I think just to summarize it again, in interest of time, we want to take a lot of questions. Post investment, we actually sit as a, our credit committee actually analyzes. We get monthly MISs from every, company that we work with. Large companies give us MISs on a quarterly basis. So in whatever frequency we get the MIS, post receiving the MIS, so every month, our credit team presents the entire data to the investment committee internally. We spend one entire day in assessing the financial health of all our existing relationships and looking at it, whether it is deteriorating, whether it is improving. If it is deteriorating, we take steps to decrease our exposure with them, and to reduce the number of transactions that we will do with them. We typically work on a sanction basis. So we basically sanction a total amount to a counterparty. So if their financial health is deteriorating, we will reduce the sanction. And conversely, if it is improving and they are really doing well, we can also look at increasing the sanction, which will then go through a credit process all over again, right? But the important fact is this is done on a monthly basis so that we can be proactive rather than reactive, right? And typically what we have seen is, and we have actually exited one or two relationships, that we have had because the financial health has been deteriorating. And even counterparties really appreciate the fact that we are able to exit the relationship early on and not at a time when they are in stress, so that also helps us maintain relationship with the counterparty that we work, which become very critical, from a long term perspective as well.
So I think while we are doing it, I think I'll start taking maybe some questions as well. So I think maybe we'll summarize the overall what we covered one more time, Saurav, and then we can go into the questions.
Absolutely. So this is, what we would like to summarize the product for you in. Why is this product there on Giraffe as a platform? Because as Giraffe, we want you to create a fixed income or a debt portfolio. Any asset class, whether it is equity, whether it is, fixed income or anything, it is built on a diversified play. What we mean that is, you don't look at specific opportunities, you invest across multiple transactions in a specific asset class. For example, I'm sure most of you are investing in stock markets, in equities, or in mutual funds. You don't put all your money in one mutual fund, you don't put all your money in one share, you do it across 10, 20, or maybe 5 or 6 when it comes to mutual fund. Similarly, in fixed income, you should invest across multiple product, multiple counterparties, so that you have diversified risk. And as Giraffe, we try to give you all products across the risk reward spectrum. So you should have products with low risk, products with high risk, so that you get higher returns, products with less tenor as well as long tenor. So you create a portfolio of your choice. And as a part of that effort, one of the things inward discounting does is, obviously, for short tenor investment, it gives you higher yields, right? Please note that the high yields are a reflection of risk. So the risk adjusted return across product on Giraffe will be similar. The fact that for 90 days you are getting 12-13% yield is means, and whereas other 90-day products are significantly lower, means you are taking significantly higher risk. The other thing is obviously the tenor of the product. So we also want to give you products where you can invest some liquid capital and manage your liquidity. So the short tenor of Invoice helps you do that. So that short tenor and the yields for that tenor, which are risk adjusted, those are the reasons we do these products. What are the downside that everyone should be aware of? One, Invoice is a product which is prone to delay. And why is it prone to delay is because how much ever we mitigate risk, but there are off chances that these things happen, and that is why we keep repeating, no investment is safe. You are earning higher returns on any investment because you are taking higher risks, right? So, and these are some of the risks. So they are prone to delays because of a lot of sometimes simple logistic and operational challenges. As I mentioned, we build in enough buffers to mitigate it, but sometimes there will be inordinate delays which may not be in our control. We have not seen this situation till delay, but these are all possibilities. Second is unsecured nature of the product, which makes this high risk. Typically, when you see NCDs or other long tenor product on a platform, they are better secured because they will have a lot of security in terms of personal guarantees, corporate guarantees, maybe hard collateral, etc. Here you're taking a call on the receivable, and because it's only a receivable, there is no hard security typically attached to these, so they are unsecured in nature. Third is that in case there is a default and they have other lenders, you are sitting, because of the unsecured nature of it, you're sitting in priority lower than a secured lender. So recovery of money, even in case of default, becomes difficult, right? So these are all risks that you need to be aware of. So when you're investing in invoice discounting, while you like and appreciate the short tenor and yield of that product, please remember these are unsecured in nature. There will be other risks associated with it. So when you do, please diversify not only within counterparties in invoice, but also across other products. So when you look at your portfolio exposure to Giraffe, you keep this in mind. So this becomes very important. Diversification is key, and understanding the risk of the product is key. And I think we would like to end our, I would say, presentation with this. Finally saying invoice discount is a short tenor and unsecured in nature. That is the takeaway. So please invest keeping risks in mind. As Giraffe, we do a lot of hard work in trying to mitigate all of these risks. But there are, because these are underlying risks of the product and inherent to the product, there will always be some risk, which is like, for example, COVID, a black swan event. There are these things which are always unexpected and you can't plan for it, how much ever you try to, right? And that's why the underlying risk of the product is important to understand. And that's what we are trying to at least hope that this is the takeaway of the today's webinar or presentation. And now we can start taking questions, JP, I think.
Yeah, okay. I think I will summarize a lot of the questions. I think one of the things you already covered, whether it's a secured product or unsecured product, you have covered it. So I think a lot of questions goes away there. Second would be, which is talked about, is what happens. There will be always some cases where 1 or 2 days or 7 days, 3 days, some payments could be delayed, right? And that is that scenario you told that it could definitely happen tied to it, but we are taking actions tied to it. But that could happen even if they are very, very good vendors and with respect to, and also the anchors, because we are talking about working capital, money movements here and there. So Saurav, I'm assuming that could happen, and we have trying to take precautions, but that's a genuine risk that comes along with it. And then the other thing is, do you finance 100% of the invoice, or you finance only part of the invoice? Right?
Yeah, so we typically have we finance about 90% of the invoice. So 10% buffer is what we keep, which is the adequate thing for including our returns. And yes, so we don't do 100% of the invoice.
Yep.
JP, I am also seeing a few questions. I can take it, this for everyone's help as well. And you can then go through the rest of the questions because there are a lot of them.
A lot of it,
so,
yes.
Yeah. So I see one question, are the invoices in your custody? Yes, we are discounting specific invoices. These are uniquely identified invoices that we are discounting. Today, most of invoices also get raised digitally. So we have all the invoices in our custody. I mean, like whether they are the digital copy or not, but we have it in our custody. They are specifically and uniquely identified. And if you see your, I would say, agreements that get, attached to the documents post the signatures, you will see the list of those invoices. We can also share the invoice numbers and invoice copies with any customers who have invested in the transaction if interested, right? So we are happy to do that. How do you identify there is a bank lending, and how do you ensure you're getting right information? Because there is no legal obligation of the company. There is a lot of data available on public platforms, and that is why government RBI has made all of these things mandatory. So for example, if you have a bank borrowing, all banks create charges, which is the security. those charge and security will reflect on a platform called Register of Charges, which is the ROC platform. If you go and check any company's ROC record, it will tell you all charge that have been created by all financial institutions. Right, so that becomes your go-to place to check. There are other websites to check legal cases, encumbrances. If there is a property and an encumbrance, you can go check registrar offices. So there's a lot of data available, which is to ensure that these kind of things don't happen. We have access to all of that information.
I think one of the questions I would say is, so if the payment doesn't happen, for example, the anchor delays the payment to the vendor, that's Vivek's question. So is there an obligation for the vendor to pay that time, or the vendor can take the time until the anchor pays back the money and then does it? So what is the obligation on the vendor if there's a payment delay from the anchor?
Yeah, so typically the way we do this is that we put the obligation legally again on the vendor, that as soon as the payment comes from the anchor, so if, for example, we have discounted a transaction for 90 days, let's say the money comes after 100 days, we've passed the obligation on the vendor to repay us on 90 days, right? So that is how it is. So and that's why it becomes very important to ensure what is the liquidity position of the vendor, what is the balance sheet or financial strength of the vendor. Can they manage that working capital gap for 10 days, because now they have to pay money which they have not received, right? So typically, so this is how we pass the risk. Yes, so I think that answers the question. So in most cases, we pass on this risk to the vendor, and we also typically invoice discount high quality invoices to ensure that buffers are built in, that this case does not happen, because finally we don't want the vendor to get into a liquidity trap where they have to pay money which they have not received. So that has been de-risked, like I said, by a lot of data to ensure that the buffer is built in adequately, so that 99% I would say the vendor gets money before the due date, right, which is what is built in. But the obligation still be passed on to the vendor. I hope that.
I think yeah, I think there was a lot of question on taxes. Maybe one answer we can do on taxation.
Yeah.
Okay, so that will cover all the tax related questions. How it is taxed? Do the returns on interest paid back are taxed? At what percentage typically before?
So the returns on inward discounting is taxed as per your income bracket. So if you are in the 30% bracket, or 20% or 42%, whatever your income bracket is, the income from inward discounting will be taxed as per that.
Okay, perfect. I think I have a question on using credit card for investment. Mr. Karthik, we don't currently accept credit cards for doing investments. So hopefully that answers your question. I think a lot of questions on okay, should I assume that the rates we talked about it, the rates, if the returns are high, which means the possibility that the risk is higher. I think that's how they should be reading the deals on the platform.
Absolutely. So if and I think there is no free lunch in this world. I think that is a fundamental starting point. We should always begin with. Wherever you are getting higher return is because you're taking higher risk. Risk also comes with tenor. So please note that in inward discounting, you're getting 12-13% in 90 days. Typically, a bank fixed deposit in 90 days will give you 5% return. So typically short tenor products give you like short-term mutual liquid funds, overnight funds. These give you returns in 6-7%. Right, so you are getting a significant delta. That significant delta also is a measure of the higher risk that you're taking, which we already have spoken about, and hope you guys have appreciated. So.
Yep, I think then maybe we can cover one thing related to on the same note. I think they are asking about the different counterparties. Can we put information on the platform so they can understand this? So I think I will probably answer for all those. Yes, we are in the process of putting information so that we can give you some sort of a scorecard for the risk in terms of scale, which would help you probably choose and understand which one you want to choose in terms of risk and reward. So that is one question I'll probably cover it. I think one.
Sorry.
Yeah, go ahead. Finish it.
So I was seeing an interesting question. So the question was, if Giraffe is doing all of these risk check, then what is the percentage chance that we will see default on invoice discounting opportunities, right? I think a specific percentage is difficult, but it is good. I think this is a good question because it'll give perspective on how everyone should invest. See, typically, where we are doing a rigorous credit process, we are very cognizant of, the counterparties that we work with. There are two, three things that we do. Our exposure today is diversified across, let's say, 20 counterparties with whom we do invoice discounting. That means we don't have more than, as a platform, more than 5% exposure, to a particular counterparty. I would request everyone that all investors, what we've sometimes seen is that people have a tendency to invest a lot of amount with the same opportunity that they like, because might have they have seen a good traction in the past and they do repeat transactions in that same particular invoice. My request is to diversify your investment across multiple counterparties. So like we have diversified ourselves, even if investors diversify themselves, that reduces the risk for you further. Second is, typically on a long-term average, if in a well-run process, these defaults should be less than 1%. So what that means is that if you continue to invest across Giraffe, across many opportunities in the future, probably 1% or less, most likely less, is what is the chance of default. And if you, in most of the cases, and it defaults, you will not lose 100% of your money. You might lose partial money. You may lose 100% as well. So the point is, if you diversify enough, invest across multiple opportunities, across multiple risk points, even in a 9% product, in a 12% product, a 14% product, you should invest across all risk points so that you're diversifying yourself. And if there's a default and it says there's a partial or complete loss of capital over a period of 4 or 5 years, you will still see that you're making that double-digit plus returns in fixed income as a space, right? And like I keep repeating, any asset class is not about an opportunity. There is downside risk. You can lose money in equity in a particular opportunity. You can lose money in in real estate. You can lose money even in gold if you invest only for 1 year. You can lose money in every asset class. But the point is that you diversify, invest over a period of time, and you will see that on a portfolio level, your returns are good, and that is how you should look at any investment product or any asset class.
I think there are a lot of questions. Maybe I'll take one to cover everything. Liquidity. Is there an option for you to provide liquidity is one. And then insurance is another thing that comes a lot of questions. Maybe we can address those two.
So on liquidity, we are working. There are today actually there is no, I would say, perfect regulatory structure to offer liquidity, and that is why we don't provide it, right? So we will once we are still finding solutions to it, and once we are able to find the right solution, we will bring it to you. The second is sorry, I missed the second question.
Second one is some sort of an insurance that gets
so
you
we are actually
promised.
Talking to a lot of insurance companies, including Tata Insurance, IFCO, Tokyo. We also started moving to a lot of bank guarantee, backed invoices. So you'll see a lot of invoices which are backed by bank guarantee, and we will also start doing invoices which have a credit insurance associated with it. So these are all products we are still figuring out the structures with the relevant people that we work with, and we keep innovating to bring you products which are better from a risk reward perspective. So hopefully over the next 3 to 6 months, some time frame, you will see these products on a platform which is backed by credit insurance, bank guarantees, etc. And we will keep everyone posted when we launch these opportunities.
And I'm going to assume, Saurav, as when we do this, I think if it is insured or guaranteed by bank, and the returns tend to be lower than the other ones. Yeah, yes. Absolutely. I think that's
no free lunch in this world. So
yeah, absolutely. So it's good to at least say that. I think otherwise, Saurav, everything what comes. When we talked about the default, we talked about the legal action. So what is the actual legal action Giraffe would take if actually something happens? So maybe we can spend 1 minute because we didn't speak a lot on that. Maybe.
So see, finally, let's take two situations. So if there's a default, we take these post-dated checks. In some cases, we have some guarantees, indemnities. If it's a misrepresentation, then you can, obviously take them to court for misrepresentation. So let's say if there are some guarantees or post-dated checks, right? So those are legal actions that you'll immediately take. You will basically deposit a check. If the check bounces, you will take them under Section 138 for a check, bounce case, which becomes a criminal offense. So actually, people are very wary of defaulting on checks because today check bounce is a criminal offense, which also means it's a non-bailable offense, right? So and that's a big deterrent. That's the reason we take these post-dated checks. The second is if there are some kind of guarantees or indemnities, we kind of invoke them. If, for example, I think in one case in our platform we've taken a personal guarantee, that also means that then you can actually try and liquidate the financial assets, obviously through a court process, of the defaulter. Right? Let's say these guarantees don't exist, then typically your recourse is that you can drag a company to an NCLT court, which is a bankruptcy court, and so that then the NCLT process will take its due course in trying to get your monies back. Right? So that's typically the two legal recourses. Obviously, we try to also work with companies which have a lot to lose, so that like we said, we do a lot of reference checks. So we try and mitigate. The intent of Giraffe is to not be reactive, but as I said, be proactive. So we spend a lot of time to ensure there is no default. But I think since the question is if there is a default, then these are recourses that is available.
Yeah, I think we covered that. I think one other question is why can't these guys are so big, they are so good. Why can't they just go to banks and get this money? Why do they have to come to Giraffe? I think 4 or 5 questions on that. Maybe we'll answer that as well.
So typically, most companies that we work with also work with other banks, right? So the idea is not to work with be the only lender to a particular company. We don't, in fact, like to work because we also take a lot of reference checks. Banks also help us get a lot of, I would say, confirmation on the conduct of the promoter, founder of the company, how they have behaved with the bank over the last 2-3 years. So that actually gives us a lot of comfort. So we work with companies who have money from banks. Typically, what happens is that banks are very templatized in nature. That means that they are not able to understand the company and give specific solutions. They will give solutions only in a fixed template. Typically, that is not good enough for the company. So companies are looking for either more capital or some flexible source of capital, which is where platform like Giraffe becomes handy, right? And so we are able to understand the company's business and provide them solution basis their business nuances and give them structured solutions. And that is what most of the companies who come to us actually like about Giraffe, and that's where they find value, right? So like companies typically have a working capital requirement of 60 crores, but a bank for whatever basis their internal process has sanctioned 20 crore limit. So what happens to the 40 crore which they need, which is genuine need for their business? That's where Giraffe can come in and actually sanction amounts. So this is one example. So these are things that we are able to do because we actually spend a lot of time with the companies and understand their business needs.
I think broadly, I'm just conscious of time as well. So, I mean, I think a lot of questions about other platforms and things. I mean, the answer I would probably give is some of the counterparties could be approached, could probably have invoice discounted in other platforms as well, but because it's a large market. So I think there is nothing like one invoice is getting discounted, same invoice is getting discounted in 2 different platforms. I mean, that doesn't happen. But I think that's another question.
Yeah, just to answer that, JP. So if it's across multiple, like we said, again, we like to we take a lot of, if there are other lenders, we take a lot of care to ensure that we understand there is this possibility of overlap. So the checks and balances are that much more. We also take a lot of representations. The money where we disburse to the through the vendors. So there are a lot of checks and balances to ensure this, especially if they have other working capital providers. So that's something that we look at.
I mean, I think covered directly tied to invoice discounting. I mean, there are some questions on other because of the fact that it's not tied to it. I won't take it. But broadly, overall, I think Saurav, I mean, until you see anything that we have not yet answered. I think investment sizes, I mean, we try to reduce it at times, but mostly we try to keep it at 95,000 minimum. Website, escrow accounts. Yeah, I mean, competitors, I think we already talked about it. There are platforms that do provide, obviously. I think we try to make sure that we are horizontal in nature. We do more product categories. And within each category, we try to give different counterparties. And even within the counterparties, you would probably see there's a good variety in terms of very, very low risk. I'm not talking about Invoice, but also all the other products as well. So we want to create that kind of a diversity so for the investors to choose a good portfolio among everything.
So,
Uh,
everyone on this webinar, invoice discounting is one kind of a fixed income product. And, fixed income is again should be looked at as a portfolio. So while, people like, and you have seen there's a lot of traction in fixed income in invoice because of the short tenor. Like we said, to ensure that your risks are diversified, we actively encourage everyone to invest across every product, long tenured ones, even commercial papers, if, obviously the ticket size is high, but, for people who can, so that you're diversifying your risks and also investing across multiple names, across multiple categories. Please look at this as a portfolio and not as a specific product, which is invoice discounting or a specific counterparty.
Yep. I think with that said, I will probably, yeah, I'll probably, we can come to close because I think we're 10 minutes over, Saurav. I think
Yes.
I do want to, and if I didn't pick any of the questions, I truly apologize because I think there are a lot of questions go. Some of them are not tied to invoice discounting, but more general. So please write to customer service or anything. We'll try to answer. I'll try to make sure that we answer those questions. But thanks for everyone for taking the time, and thanks Saurav for joining as well. So we'll again meet you again on a different topic on Giraffe Connect. Good night, everyone, or good late evening, everyone.
Thank you everyone for joining in, and, good night.